Hello, everyone. Today, I'm going to get into some data here and kind of figure out what's going on with the markets, where the real estate is headed, what is going to cause problems potentially for real estate, commercial, residential, industrial, what will have the biggest issues, what will have little to no impact, what is the Federal Reserve's game plan, and what is going on with unemployment and the real story. Because right now, unemployment showing is not too bad at all. That could change pretty quickly here. And my biggest fear I have as Federal Reserve gets ready for their next meeting, and if they increase the rates, if the rates get increased this time, one more time here, I think we're in for some major market chaos. And what will benefit? What markets and what assets will benefit? So let's jump in. Let's jump into something very interesting here. First, kind of disturbing, a little bit disturbing here. The government is, let's go to switch to this one. All right. So the subsidy, this is what Joe Biden instituted here. Will investors with higher credit scores pay more to subsidize people with lower credit scores? It's not investors. Okay, so let's take investors right out of it. It doesn't affect asset-based mortgages. It affects Fannie and Freddie Mac. So it does affect conventional buyers. And this is really something that's, again, I think just done to cause chaos. If you think the World Economic Forum and Klaus Schwab, you'll own nothing and be happy. I think this is part of the process that they are instituting here that's going to continue to make home ownership just more and more difficult and damage real estate market to an extent. Nothing huge, but it's a start. So what they end up doing here is they're subsidizing people with credit scores of 620 and below at a 1.75% discount, and people with 740 and above FICOs are going to subsidize that and pay an additional 1%, which is really, truly ridiculous, to be honest with you. I mean, this is absolutely insane. You're rewarding people who are terrible with their money, not diligent, and shouldn't be home buyers, should be renters, potentially, for people who are good with their money. So you're disincentivizing people to do the right thing. Basically, you're completely doing the opposite here. It's the definition of insanity. It's everything that this government, this current administration does. And it is just trashing the country. And it's going to affect us here for a while. As you see in this article here, bigger pockets here, it really affects Fannie and Freddie. Not so much FHA and VA loans, but Fannie and Freddie mortgages will subsidize, which is conventional, will subsidize it. So people with 15 and 20% down are actually going to be hit the hardest, unfortunately, with this here. And people with FICO score 740 and above are really going to get hammered here. So truly bad with what they're doing here. This makes no sense. And here's a little chart on it. I don't want to get too much of that. You guys can look at that in your own time here. I will switch to this other tab here. This is on Mortgage News Daily, and it'll tell you what lender loans does this apply to, what are the fees and costs, debt to income ratio, what changed. And this is probably a pretty good article to look at here. But it is going to affect real estate. It will affect real estate, maybe not majorly, but there's going to be effects from this, right? And you hope this gets reversed, because this is absolutely insane what they're doing. Anything the federal government does is pretty much the same, in my opinion, anyway. All right, now let's get into what is going on in the markets here. So a lot of you probably have heard First Republic Bank was the next bank to bite the dust here, and it looks like Chase is going to end up purchasing them. They're bailing them out because of their incompetence, which is a shame here. And I think, you've just kind of started to scratch the surface here on bank failures. You're going to have more and more and more bank failures coming about. It's just going to get worse and worse, unfortunately, and not good for the economy. as we have more and more bank failures, people are going to start to really, really lose their faith in the bank. Again, this is intentional. And let me get back to the Federal Reserve here, because I fully expect these idiots to raise the rates, which is going to cause market chaos by raising the rates. There's a domino effect here. So the cost of your short-term lending what the bank borrows from the Federal Reserve goes up, and they have to meet their reserve requirements, right? So their costs go up. Some of the assets they bought to protect the 30-year treasury bond, we'll call it, loses value. Now they don't have enough to cover their funds, and investors who are people that are depositors in a bank and basically just have an IOU with the bank are going to start to pull their funds. And then that's what happened here with First Republic Bank, and basically get bank runs. And here's me more and more of these. And the Federal Reserve wants to create their own central bank digital currency, the CBDC, the Fed now coin, and they want to do away with banking industry the way it is now. This is the whole transition from the old financial system, banking the way we knew it, to the new financial system, which is going to be all blockchain based. And the CBDC will be based, it'll be a blockchain based system. Good in some ways, not the central bank's one, because you can see all the transactions. They're going to be able to monitor every transaction you make, every purchase you make, everything you do. And with that, they could restrict or penalize you if they didn't like what you purchased or what you were spending your money on, or weren't spending it quickly enough, whatever they have in mind. They control that. So what's going to happen here? What asset class will benefit? And the answer is a lot of benefit. A lot of asset classes will. Some people may go to the stock market more. However, I think the stock market is going to have a pullback. I just don't know when. Who knows, right? The asset class that'll get the most appreciation from it will be cryptocurrencies. Bitcoin, which has its own blockchain where you custody it, you control it. Nobody can tell you what to or restrict what you do with it, right? If you want to use it to purchase something, as long as the place accepts Bitcoin as a currency, you can go ahead and do that. If you want to do peer-to-peer transactions, and that's what Bitcoin was made for, you can do that and not have to worry about any third-party intermediary, right? It's permissionless. There are roughly around 72,000 computers on a Bitcoin network building out the blockchain, and those computers need to agree on a transaction, and hence why it's permissionless here. You don't need a third-party intermediary to do this, right? Like the Federal Reserve, or whenever you're sending a wire, you need a third-party intermediary to verify, yes, the funds are there, send it to this is a good account. You don't need that with Bitcoin. And it puts the power back to the people. And not just Bitcoin, there's other cryptos you can use as well. Bitcoin is not used for fraud and abuse like the federal government or these idiot politicians like to throw out there. It's just not the case, because you can see the transaction in a blockchain. You could see whose wallet it came from and whose it went to. So forget this nonsense that's used by drug dealers and all that. Other ones can be used, like Monero, which is totally hidden. Nobody knows where it came from, who it went to, completely. And that one will benefit, by the way. Monero will benefit hugely from all these Federal Reserve CBDCs, all the CBDCs from all these central banks throughout the world. And they're all instituting them. Obviously, they have one in China, the digital yuan. So we're getting ready to institute ours. I think it kicks out in July officially, if I'm not mistaken. And there's going to be other countries doing the same thing, other central banks doing the same thing. But this will push people into cryptos. What other asset classes will go to? Crypto will get the biggest benefit, I think. But you're still going to be up and down with it, right? And cryptos, because it's not as easy to custody like it is a bank account, because you have to self-custody, and you have to use something like a Trezor wallet like I have here, then it makes it a little more difficult, especially for older population. Younger population is more tech savvy, can do it a little bit easier. So it's going to become more and more popular as the younger generation gains a little bit more wealth and utilizes these cryptos more, which I think we're going to see over the next few years here, the transition from the old financial system, the old stock market, the old banking system, to the new financial system, which is going to be all blockchain based. And you're going to want to be in the right things. A lot of people are going to get paid in CBDC. I personally am going to want to have it more in my money into cryptos. If there's a stable coin that's really truly stable, that seems good. I will utilize that to an extent too, but there's risk with that. Again, I'm not saying it's not a riskless class. It's very risky for those that are uncomfortable with it, but you better learn it because it is the future. Now, another asset class that's going to benefit is residential real estate and industrial real estate. Industrial space is still in hugely high demand, and single family housing is still in hugely high demand. And commercial residential, being apartment complexes, whether the small or large, are going to be huge demand and have huge benefits coming up on this. So those will benefit. What's going to get hammered? So let me go to take this off here. Stop screen sharing for a moment. Commercial, retail, office space has already been devastated and is going to get hammered more and more because there's plenty of supply, no demand, because people are working virtually from their house, from wherever they want to be, right? And these office spaces, the same amount of office space is not needed for every company. There are some where you still have to be in there, you still have to do it, but a lot of places where people used to have to be in call centers, they don't necessarily have to be in a call center now. They could be in their house on a call as doing a call center, and it'd be a lot less chaotic. And you don't have to worry about driving. So, fighting traffic, rush hour all the time. So there's a lot of benefits with that. But this space is going to get crippled. The office space and retail is going to continue to get hammered more and more. And with what controls the rates with these commercial mortgages is the short-term rate, the prime rate. When that keeps continuing being raised by the Federal Reserve, you're making the costs go up exponentially more. And when these 5-year resets, some 3, there's some 5, there's some 1 year, there's some 10-year, 15-year arms on these properties, as they come due, the rate is going to drastically increase. And guess what? These investors are going to walk away from these mortgages. Who gets stuck with them? The bank. The bank is now stuck with these bad assets, crippling the banks, absolutely crippling them. And your regional banks are hugely heavy into these commercial office space, industrial, and retail spaces. So this is going to cripple a lot more banks. That's why I say the carnage is nowhere even close to started. We are just at the tip of the iceberg. We're going to get a lot more. So what's going to happen with residential real estate? Of course, there always is that trickle down. You're going to have that effect, that domino effect, where you're going to have unemployment go up. You're going to have inflation continuing to be a problem, right? I don't know how much longer that's going to last. It's come down slightly, but not enough to be a factor to really help. Interest rates need to continue to come down. Long-term interest rates, I'm talking about now, the 10-year Treasury bond that's based off for the 30-year mortgages. So those need to come down so that the cost of living can come down a little bit. But that's not been happening too quickly. They shot up last year from 3% to 7.25% roughly, or 7.22. Now they're going back down around 6, upper 5s, lower 6s in that range right now, which has helped a little bit, but not enough. And hopefully that trend continues and we continue to go down in the middle 5s and lower 5s, where it becomes a little more affordable, and us as real estate investors can take advantage, maybe do a cash out refinance, lock in a long-term lower interest rate that cash flows very well over time, because we're going to continue to have high demand for rentals because we have a southern border that's not being monitored. So we got more and more people coming in and they need a place to live as well. So there's going to be a lot more tenants, and there's already not enough housing being built, and the cost of all the materials and all the housing, it just keeps increasing. So affordable housing is going to be a next great opportunity in real estate. And, don't think necessarily about the 5-bedroom, 4-bathroom, 3,000, 4,000, 5,000 square foot McMansions. We're going to need to shrink down these properties, make them more affordable to build, more affordable to live in, more affordable to heat and cool. And I think some of the smaller housing, whether it's a modular home, whether it's, you're going to have 3D printing continues to get better and better and lower costs. These things are going to help bring some of that down, but the government really needs to get involved and incentivize investors to make this more affordable housing. Because right now, you're making pennies to nothing on the smaller houses, but you're making much more money on the larger houses. So until they incentivize, which they probably won't, this administration will not. They do not care. They do not care about your average Joe. They don't care if you have a place to live or not. They claim they do, but it's all fake. All right. Enough about that here. Let's see what else I have to show you guys. All right. Let's get into some of the Redfin housing data here. So what we got going on here, this is March. And, February, of course, we had a year-over-year increase. We have the median sales price going back up, which is good. It's typical this time of year. It's this spring market we're starting to hit. So March, April, May, June, July may look good. And then August, September, October, November, December, January go down in value, but probably not a huge amount. We have such a limited supply of inventory and such high demand. Despite the fact the rates are higher than they were a year ago, there's still a high demand. A lot of people still want to move, relocate, go from a smaller to a bigger house if they can, or some people just want to go from a bigger to a smaller house. You have a little mixture in there, but we got low inventory and we got stable to slightly rising prices. We are down year over year 3%, which is not much at all, right? That's relatively pretty good. Median days on the market's up 23 days from last March, which was a rabid market, to this March, which is not bad, a little more than double, but still nowhere near a real regular market of 30 plus days on 30, 40, 50 plus days on the market, and a regular market you'll get. All right, let's look and see what we got. Basically, this is new listings. Like price above ask was 102.4. Now you're closer to ask, just about 99% of ask price. If you price the property right, if it's a nice property, it's going to move quickly right around that ask, maybe slightly above, slightly below, basically is what we're getting here. This is the time of year we're going to start to have more and more homes sold, and inventory just started a slight uptick. So we're going to benefit a little bit from that, and that should keep pricing from going up too much, but it's just a slight increase. Wave contingencies, normally this time of year, again, it does get waived because there's more competition, more people looking to buy, and you have constricted inventory. So you're going to have more wave contingencies than you do in, January, December, October, September, that time of year. So that's some of the data that we're getting there. Now let's look at where rents are rising, because this is important, right? This is telling you where you want to be looking for rentals for the future. Raleigh, North Carolina, which is a big tech hub, is up 16.6%. That's pretty substantial. Cleveland, red hot market, up 15.3%. Charlotte, seems like this market's been hot since the 1980s, is up 13%. Indianapolis, just an affordable market, nice linear market, continues to go up. Nashville continues to grow, as does Columbus, Ohio, Kansas City, Missouri. Interesting to see Riverside, California must be a more affordable area. Denver, interesting. I guess as housing has become more expensive, there's more demand for rents. And St. Louis, Missouri is a great rental market. So no surprise that that's looking pretty good right now. All right, let's look at mortgage rates. And this was as of April 26. So mobile mortgage rates retreated this week, which is good. It's trending in the right direction. We want it that way as investors, as future homeowners, people that want to buy a home. You want the markets come down and bring that monthly payment down and make it affordable for you. That is for sure. All right. So mortgages obviously are a huge impact on what goes on in the market here. All right, I'm going to stop sharing. And what else do I have to hit here? So the commercial real estate crisis, let's go back to that. We talked about that. That's really going to be the retail space, the office space. They're going to get hammered. Industrial still going to be in demand. Single family rentals still going to be in demand, still going to be solid. You're going to have corrections in certain markets that have higher inventory, ones that have low inventory. As long as rates stay flat, relatively down a little, maybe only up only slightly, you're going to have stable pricing, very stable pricing. Whether we hit our bottom or not, we'll see. There is talk at the rate because February pricing went up. We could see an increase this year, but it really depends on rates. If rates retreat throughout the year, yeah, we're going to see an increase in pricing, especially in those markets that have very little inventory. But where they have high inventory, you'll still see prices retreating. We're seeing that in Illinois, California, Phoenix, Arizona, Denver, Colorado. Those markets are starting to get hit a little bit. Florida is still high in demand, but it's going to be flat in some areas, except for places like Tampa, where it continues to go up, and there's smaller markets. Miami may end up having a little bit of an increase. We'll see, but there's still demand. Still a lot of people looking to move down here. Still a lot of baby boomers looking to retire and come down here, and I expect that to continue over the next 10 to 15 years or so. So we'll see where that goes. But it's kind of what's going on in the market here. It's what we're seeing, what I'm seeing, but look for the Federal Reserve to increase the rate, which is going to cause chaos in the markets, and it's going to be, make it tougher. 2024 is going to be tougher. 2023 for real estate looks fine. 2024, we'll see. Early stages of it, I think the early part of the year might be good, but I am definitely starting to get worried about later on, especially if rates increase. If rates increase for this year, forget about for 2024. It's going to be a declining year. But there might be opportunities. We might have more inventory. We will see how that goes. With more unemployment, you're going to have more inventory because people are going to be forced to either liquidate funds they have in the stock market or liquidate real estate, those types of things. Oh, one other asset class I forgot to tell you that's going to have a benefit from the Federal Reserve doing what they're doing. It may be delayed because it's kind of a manipulated market. Silver and gold, especially silver, which is manipulated by JP Morgan, but the gold market as well. They should have a short-term bump, but we'll see how long that lasts. Cryptos will get that same short-term bump. They'll be up and down. But as people see what's going on with the banking system, there's going to be less and less faith in a banking system, which is going to push more and more people into CBDCs. But the smart money is going to be going into the right cryptos, and there are the right cryptos. Ones, and we'll get into that, and I'll talk about that again on this channel further down the road, which are the best cryptos to be in. But you can't really go wrong with Bitcoin. Ethereum's a good solid one right now. They're developing so much. Litecoin, another great one, transactionally based. Bitcoin Cash, transactionally based, very quick blockchain, similar to Bitcoin, but doesn't potentially have the same long-term growth. We will see the Lightning Network has really sped up Bitcoin and made it more easily and cheaply used for transactions. But there's plenty of other good ones out there. Some great projects coming out, and we'll start looking at those on this channel as time moves forward. All right, thanks, guys. Appreciate you, and catch you on the next broadcast.